Hi everyone, my name is Sam Decourt and welcome to our July market update video. Joining us today is Pi Fund's Chief Investment Officer Mike Taylor, as well as one of our investment advisors, Simon Hepple. Hi Simon, hi Mike.
Hi Sam.
Hey Sam.
Let's get started, Mike. So what's been happening in markets over the past month?
Past month have been very bullish for markets. Markets continue to make new highs. As we are recording this, it's yet another high for the ASX, the NASDAQ, and for the S&P 500. What's driving that, I guess, is the market has become, rightly or wrongly, very comfortable with the tariff situation, and that the threats, a lot of them continue to get walked back, despite the fact that actual tariff levels are materially higher than they were at the start of this year. The market is just walking through that. And why are they doing that? Well, that's because the US economy is actually remaining strong. And the thoughts are that even when the tariffs do kick in terms of increasing prices in the next couple of months, that the US economy will continue to grow. So, and finally, last point I want to make on that is reporting season has started strongly in the US, and that's leading through to higher equity prices.
All right, thank you, Mike. Now over to Simon. Simon, you've been an investment advisor for around 20 years. However, this is your debut on the Pi monthly video updates, so welcome.
Yeah, thank you for the
invite.
Want
to talk a little bit about investor psychology. So you and I and the team talk about how often we hear in periods of volatility from clients, people who have cash to invest. Oh, look, I'm just going to sit on the sidelines and wait till everything calms down a little bit before I invest. We hear that a lot.
Yep.
Is it a good strategy?
No, terrible. I think it isn't a great strategy to keep a lot of money on the sidelines, simply hoping that things are going to turn around. I think it's extremely unlikely that any investor knows when to deploy cash in an optimal way, based on what the market happens to be doing. No one rings a bell to signal when to invest. My personal opinion.
Oh, I thought they did. Sorry. I'm still waiting for it.
Often the best strategy is just to remain invested over the medium term, just to iron out any volatility. Every client believes that they know when the market's going to, be at the lowest point. But yeah, markets tend to trend upwards. Assuming an investor has a time frame of at least 5 years, they should have some exposure to shares in their portfolio.
So Simon, for people who have money in cash in the bank, who are either looking to implement a new portfolio or add to their portfolio, when is the right time to deploy some of that cash and invest?
Well, just based on history, the best time is basically last year or 3 years ago, 5 years ago, yesterday, now. Time has averaged out the returns, and nervous investors, because I can imagine that's a leap of faith for someone that's brand new to investing, could use a method of averaging into the markets. A stat that I like to use with clients, and I draw a lot of comfort from myself, is that over the last 100 years, 70% of all calendar years have been positive for markets. Most investors would take those odds any day, especially over a time frame of 5 years. Using your example, Sam, in respect to a term deposit, I looked this up earlier on today, 3.9% per annum for a 6-month term deposit at the moment. And whilst that looks attractive, particularly in comparison to, say, the COVID period, once you strip the tax out of that, it's, say, 33%. That's a mere 2.6% return. That's unlikely to be keeping pace with inflation over the long term, particularly if interest rates are dropping.
Thanks, Simon. And Mike, I'll ask you to comment on this as well. And just to be clear, this is not financial advice to anyone, but how would you answer the question of when is a good time to invest cash?
Well, another way to look at it is to actually deploy cash when markets have downturns. We've often seen in this business that people do the opposite. So when markets go down, they take money out. And I could probably count on one hand the number of clients who put money in when markets go down. But that's actually, a reasonable strategy. If you have a little bit of powder dry that you could say that you can add to markets when they fall. I'm not suggesting you keep everything waiting, because sometimes you might be waiting 3 years for a market to downturn. And in the meantime, the market could have gone up 50%. So it's just another way to look at it as opposed to averaging in, as you can say, potentially if you were someone who's new to markets, you could put in maybe 3/4 of your allocation now and keep back a quarter to add in pullbacks in markets. And, markets do have corrections. I think a 10% correction happens almost every year. So there is always an opportunity out there.
Mike, changing gears quickly. So last week, the business hit a milestone where our flagship original PI Australasian Growth Fund reached a $10 unit price, which means that it has gone up 10 times since it started, or since you started it in 2007, so 17 and a half years ago. 10-time return. Compare that, random comparison, Auckland property up about 2 times over the same amount of time. Looking back 17 and a half years, what have been the biggest lessons you've learned?
Well, I feel like that particular fund has been through so many different events. It's been through the GFC, it's been through the Euro crisis, it's been through COVID, trade wars, you name it. It's kind of weathered it. And as I said earlier on about the time to add to market is when the fund's down. Oh, sorry, when markets are down. And in fact, that fund's had lots of periods. Even though it's made 10 times its value, it's fallen 30% a couple of times. And if you'd added to your investment during those periods, you would really have supercharged your returns. So that's one lesson. The second one is that, stock markets go down, bear markets happen. If you're not kind of ready for that, if you don't anticipate that, you're almost not ready to be an investor. You've got to actually accept that it's par for the course. It's just what happens is that prices go up and prices go down. So relax is kind of the next piece of advice. And I think, it's been the other point I'd make, lessons is that it's not one individual. It's a bit of a team effort in terms of driving that price from $1 to $10. Yes, I was on my own for a couple of years at the beginning, and I managed that fund to $5, but there's been other portfolio managers who've taken it from $5 to $10, and Michael Goltzman has been in charge of that fund for the last couple of years. So it's really been a team effort from our investment process and strategy in Australasian small companies that have delivered that result. Yeah.
Thanks for sharing, Mike. And we'll wrap it up. Simon, thank you for joining us as well.
Thank you.
Thank you very much for watching and listening. We'll see you next month.
See ya.
Thank you.